Tom Wilson, 20 years ago, Allstate started trading as its own company. It was spun off from Sears. You've been with the company the whole time. So what's kept you hanging around?
People. You know, it's a great company. We got great people, and we help people. So I'm a people person. I love being around people, and insurance companies really have only two things: people and then some investments. And it's those people I love.
And what's the biggest difference now as opposed to 20 years ago in the insurance business? One would think that technology and specifically the internet has created some huge changes.
Well, you know, great, that's absolutely true in terms of how people access the product. So 20 years ago, people couldn't buy online. It was sort of a dream. And today, we have Esurance, which we bought 3 years ago. It's doubled in size since we bought it for people who want to do self-serve. On the other hand, there are a lot of people who still just want local advice, and there's our Allstate agencies. That's changed. The other thing that's changed related to technology is data. We use a lot more data in terms of running our business. It's a lot more efficient and effective for our customers, and that's been a good thing.
One would think that premiums would come down because we're a safer society, one would think, and one would think that all that data has made your actuarial tables much more true. I mean, where are premiums now as opposed to then? And where are they going as well?
Well, premiums have been, if you look over the last decade, relatively low in terms of increasing per car. That's driven mostly by the fact that there's been fewer accidents, and that's been coming down for 20 years. It's also because we're more sophisticated in our pricing, so we're better able to give you as an individual a price. Offsetting that some are inflation. But in the first part of that 20 years, there was a little more medical inflation than there was today. So some of your insurance premiums go to pay for medical costs. And that part has been relatively moderate in the last 4 or 5 years. So insurance premiums are going up right now by, this year, most of the projections are in the 4+% range. But if you look back over the last 3 or 4 years, it would be less than 3%.
You mentioned medical. We're seeing a whole lot of consolidation in the healthcare insurance space. Give me your thoughts on whether or not it's going to come to property and casualty as well as life, your area of the world.
Well, first, insurance.
We're seeing a little bit of it now.
A little bit, yeah. So, well, most people think of insurance as like one ubiquitous industry, but there's like neighborhoods, right? So there's the healthcare neighborhood, and the merger activity took off there with Affordable Care Act. Then you had the reinsurers where the merger acquisition took off after there was extra capital. So the pension funds, endowments started going in that market, and they said, oh, too much money, we got to consolidate to get our costs down. Ace and Chubb, of course, just merged, announced last week that they're going to merge, and that's the commercial insurance neighborhood. It's not clear whether that's the starting gun for consolidation in commercial space. We're in the personal lines business where we serve consumers. About half of our business is done by mutual companies, and so they're not subject to the same pressures that stock companies are. So I don't think this is a starting gun announced in personal lines. That said, like we bought Esurance 3 years ago. We're always looking for products that we could buy and sell to our customers.
Well, speaking of Esurance, that business is online. That said, you're actually adding agents in a lot of parts of the country. So how do you reconcile that when people can find insurance online, but you're still adding people and costs to the company?
Yeah, it's a really good question. What we did is we split the insurance market into 4 segments. One segment are people who want to do self-serve and want a branded product. That's Esurance. And we give them really great technology, help them do it fast and efficient. And we're very clear that we want to give them tools to make them smart. There is another segment of the population which wants local advice in a branded product. That's the Allstate agencies. And so there are still plenty of people in that segment. And so we've really designed our processes in business around them, which they want the local agency to know them. They want them to help them use it best earned money. So we don't give them tools. We use tools on their behalf. So it's about segmenting the market, and there's plenty of growth in both places.
And then finally, we've been talking about technology over the past 20 years. I want to look ahead a little bit. People are talking now about the self-driving car. So if and when that finally comes around, what does that mean for Allstate and other insurers?
Well, there's been declining number of accidents for the last 20 years because of technology. Third brake light, anti-lock brakes, airbags, all of which we've been in favor of. We were one of the early proponents of airbags because we want our customers to be safe. That will accelerate. I believe that either semi-autonomous or autonomous cars, whether it's machine-to-machine communication, GPS, other connectivity, it's going to have fewer people are going to have accidents, and that'll be a good thing. What that means for us is we need to make sure we walk into that and take it as an opportunity. So we're doing a couple things. We have a product called DriveWise where we're connected with our customers so we can give them more specific price, specifically around their driving, and that we can help them have a better driving experience. So it's like all things, it changes. As long as we're doing the right thing for our customers, they'll stay with us.
All right, thanks a lot, Tom Wilson.
Thank you.
And thank you for watching The Street.